Bo Fisher, Fisher and Weens Wealth Management. Well, here we are, Thursday, 27th, after the stock market is closed. And I'm sending you this because we have hit what's called a correction. A correction is when the stock market drops at least 10% from its all-time high. And we hit that today. It's now dropped 11%. Now, what's interesting about this one is it's historic. It is the fastest that a stock market has dropped at least 10% in the history of the stock market. So congratulations. We're going through one of history's the quickest stock market drop, at least to 10%. And so I want to send out a video to let you know what's going on and why this is happening. Well, why it's happening is largely because people for the last decade have been watching the stock market and we've had a nice bull run. And so some money managers have been expecting something to happen that's going to create selling, and they've been waiting for it. And they found it. And what it is, it's the coronavirus. So why does that matter globally and certainly economically? Well, let me explain that to you, that the coronavirus is creating a lot of fear out there. Now, whether it's the media and the scary pictures of people in full hazmat suits, or if it's real fear and is warranted, that doesn't matter as much to what's happening, or that doesn't matter because it is affecting us globally, economically. And the reason it is because people are starting to stop traveling. They're not going on vacation. They're not going on their cruises. And that affects, obviously, hotels. That affects airlines. And that affects all the amusement parks and the cruise lines. Something else is happening is that businesses are stopping conferences. They're postponing them. That obviously affects the conferences and the restaurants and the hotels. But globally, what really is affecting the stock market is what's called a supply chain. And now imagine if you're in China or other areas that are creating products and services that supply to other companies. And if your workforce is not coming to work because they're fearing this coronavirus and they're just not going in, they're calling in sick. Well, that company is not able to produce the widget or the thing that other companies are buying to build their products. So a company in the United States that's buying supplies from a company, let's say in China, they can't get it because they're just not producing it, which means the company in the United States can't build their product, and which means they can't sell it. And so the supply chain is breaking down right now. And that is what the stock market is largely responding to. So let's talk about, I am not an expert by any means on the coronavirus. I am not. But all we have to do is go onto the John Hopkins website to get some statistics on what the coronavirus is all about and how significant it is right now worldwide. So I'll give you a couple stats. I'm a statistics guy. So to date, once again, this is February 27th. To date, worldwide, there has been roughly 2,800 deaths because of the coronavirus. And there's been 0 deaths so far in the United States. But if you compare that just to the normal flu, just the influenza flu that we've had this year, worldwide, there's been 300,000 plus deaths because of the flu. And in the United States, somewhere between 20 to 60,000 are expected deaths because of the flu. So on a scale, the coronavirus and the flu are significantly different. And I'm not saying that the coronavirus is not important to keep an eye on, but I am saying that that coronavirus on a scale is small compared to the flu, but it is greatly affecting, because of the fear, our supply chain and our economic outlook right now in the stock market. And that's what the stock market is significantly watching and responding to. So let's talk about a correction. A correction, like I said before, is 10% drop. We're at 11%. Since World War II, there have been 26 corrections that have happened. On average, a correction has been 14% drop from its all-time high. We're at 11% already. And it only takes 4 months for the correction to reverse itself, meaning it'll be all the way back to where we started 4 months later. So it's a pretty quick down and up. That's a normal correction. If, however, what we're going through right now goes all the way past 20%, that's now entering what we call a bear market. And a bear market is anything above 20%. There have been only 12 bear markets that have happened since the World War II. Now, this is where it gets painful, though. If we go through a bear market, the average is 32% drop. And it takes, on average, 18 to 24 months to come back. So 1.5 to 2 years. So if this is a correction, it's going to be a down and up, most likely. But if this is a bear market, we might expect to have a longer term view of how long it's going to take to come out of this bear market. So why do we not try to time these things? Well, if you're going to try to time the market, I don't believe in market timing, and there have been study after study that shows that it is too difficult, and if you do it over a long period of time, you're going to end up losing money. And the reason is because you have to be right twice. You have to be right that the market's going to continue to go down. It is possible that by the time you actually watch this video that the market has bounced up some. I don't know. It could bounce back up. So you have to be right when you sell out that it's going to continue to go down. The second thing you have to be right about is when do you buy back in? Because the market will come back, as we all know, it always has. So when do you get back in? And you have to get back in before you got out when the market goes up. The last correction that we had was December 2018. It was a little over a year ago. And you may remember that in that month, the stock market dropped 18% in that 1 month. But it only took 1 month to be fully back. It was a fast down and up. And 18%, by the way, is significant. It was almost bear market. This graph here shows you how fast it was. And the problem, of course, is as it's going down, you have to decide when to get out. And if you would have gotten out here or here or here, but only got back in 2 weeks later, which is here or here or here, you would have actually lost money by trying to time the market. It is very difficult. So my view on investing is we need to have a long-term horizon. We need to be diverse. This is why we don't have all of our assets into one category. What I'm showing you now is the last week in the stock market. And then this green line is what bonds have done during the same time period, just this week. And as you can see, bonds have done actually really well. They haven't even really been affected by this massive stock market downturn in the last week. Last year, bonds seemed to be kind of poor because the stock market did super well. But right now, bonds are creating a ballast and a comfort level to be able to ride out some of these things. I'm not suggesting we get in all into one or all into the other. I am just suggesting how important diversity is during market volatility. So I'm expecting volatility, just like I said in my first video of the year. I'm going to continue to expect volatility. I just didn't expect the coronavirus to be the reason for the volatility, but it's here. So if you want to talk about this, if you want to talk about my view on the coronavirus, the markets in general, give me a call. We can have this conversation. Just know that I'm working hard to help manage your accounts through all of this. So until we chat, let's all stay calm. Let's enjoy our families. And until we talk again, I hope you're well.